Hi, it's Eric Ogard, CIO of the Wealth Plan Group. There's been a lot of discussion of inflation of late, and I think it's important maybe to take a step back on occasion and to think about things from a principle or theoretical basis. So when we talk about inflation, what are we really talking about? It's the purchasing power that every dollar in your bank account has. And when we have higher inflation than we would like, we have a declining purchasing power in the value of your bank account. So it takes more dollars to do the same thing that you did a year ago today because of inflation. And when inflation is very high, beyond the Fed's manageable target of 2%, that has consequences, and it's primarily the value of your money. So taking a step back, what is the value of money? Really, money does three things. Money is a store of value, meaning that if you have an asset in some form and you want to be able to store the value of that asset, you can convert that asset to money and then store the money in the bank. So if you were a farmer or somebody producing any perishable commodity, keeping that commodity in sellable form has a half-life. It'll eventually rot and not be worth anything. So you can sell your grain, convert that asset to dollars, and then store those dollars in the bank. So the idea of a store of value is a fundamental feature of money. Now, if we have rampant inflation, it's not serving as a great store of value because its purchasing power is eroding. But that's the primary role of money. One of the primary roles is a store of value. The other role money plays is to provide a medium of exchange. Someone has a good or service that you want, you can give them money at the stated or agreed upon price to acquire that good or service. This is way better than having to trade your grain for the good or service. That person might not need grain. And then the third role for money is a unit of account. You can say you have X dollars worth of something, and you can account for all of the assets you have by denominating them in your currency of choice. The reason inflation is such a focus is because it erodes the purchasing power of your dollars. That's a key thing to understand when we talk about money. And after all, our entire investment portfolios or our retirement savings are denominated in dollars. So we care about the purchasing power of that money. And inflation erodes the value of that money. So the key thing as an investor, when we have this money stock represented in all of these different investments, we want the money stock to be as stable as possible. Now, in an era of higher inflation, we want our money growth, the value of our portfolio, to exceed the increases in inflation. So at least we're not losing ground to inflation. And this is why you want to carefully select the things that you invest in so that you stay ahead of inflation over the long haul. And I think that's a really good setup for understanding why inflation matters. Now, let's turn to a little bit toward money creation in the economy. Many people think of money as the dollars and cents they have in their pockets, so cash and coin. But really, when the Federal Reserve engages and the Treasury engages in quote-unquote money printing, they're doing so in a digital world. And most of those dollars are what we refer to as digital representative money, meaning that the money isn't created by rolling a printing press or rolling a coin stamping process. The Treasury merely prints enough money and stamps enough coins to keep up with the demand for exchange. And you are all probably very aware that society is moving toward digital money far more than cash and coin. Very often we're just swiping a card, meaning we're spending and receiving a digital form of money. Every 2 weeks the paycheck hits, you're getting paid electronically. That's all digital money. When the Fed is creating money, they're opening their discount window into the banking system, and the member banks borrow at the Fed funds rate, and then they turn around and they make loans at a spread higher than the Fed funds rate. That process of infusing money into the banking system via loans is how money is created. So when we look at things like the money supply and measure money supply over time, it's a reflection of the aggregate activity through the banking channels, but also importantly, through the federal spending channels. And as you are all likely aware, during COVID, everybody got checks in their bank account. Now that was an electronic transfer of funds. There were no printing presses running or coin stamping running, but we had money in the economy, and that's digital or representative money. And it's really this balance of money supplied versus money demanded that leads to, in our view, an inflationary or a non-inflationary setup. We simply printed a ton of money in that 2021-22 period that created a lot of excess money in the system. Now, we think that excess money has to come out of the system in order to perfectly quell inflationary pressures. But in the meantime, investors are left with, how do I outpace inflation with my investment portfolio? And one of the great ways to do that is a stock portfolio. You have to deal with the extra uncertainty or volatility of a stock portfolio, but throughout history, stocks have proven to be an excellent way to combat inflation. That's the thinking on money, the interaction of money, and I guess the last thing I'll say is, if we think about what the federal government is spending right now, that's still causing money growth in the economy. So even though the Federal Reserve is tight with interest rates and they're rolling off the balance sheet, on the other side of the equation, we have annual spending in the US government budgeting process is very high. And that's what's leading to continuing growth in money here after a brief period of decline. And we step back and we say, what effect is that having on the value of our money? We've still got a little too much inflation here. And so we're watching carefully the dynamic of the federal spending against Fed policy, which is higher rates and a lowering balance sheet, which is going to ultimately determine whether inflation is defeated and reaches the Fed's 2% target. That's going to be driven by whether the federal spending offsets the policies of the Federal Reserve. To a degree, what's happening in Washington is they're on two sides of an equation competing against one another when it comes to inflation. And we think this is going to be the primary dynamic that is with us for quite a while. It's really important to have stocks in order to combat the effect of inflation on your purchasing power. Now, there are other assets that might be used to combat inflation. That might be for another conversation. But rest assured, the stocks are one way to combat inflation over time, and we recommend almost all investors should have some exposure to stocks. So with that, I thank you for your time, and I look forward to connecting next time.